money in many ways is a manifestation of power. So to have a completely different system than what we have now, in some form or another, the people in power or those who are deciding what kind of system we have will have to change. And I can't rule out the fact that it won't be the United States making that decision for the new system. What I feel very strongly about is the United States will not just roll over, walk away, and let that new system come into being without them having a say in it. And if it isn't going their way, I don't think they will play nice. And it's not that I don't think that the system can change. Again, I think the dollar is going to get much stronger. And so sometimes people will think that I never think it can end. Well, it absolutely can end. But I guess my point is we have a current system. We will potentially transition to a new system. I do not think that during that transition period, it will be economically peaceful or militarily peaceful, unfortunately.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. According to Truflation, the US dollar has lost nearly 25% of its purchasing power since January of 2020. Now, many everyday Americans struggling to pay their monthly bills might argue that that's an understatement. What the US dollar does versus real things as well as versus other national currencies has very real implications, economically, societally, and geopolitically, for everyone watching this video, regardless of where you live. For a better sense of what it's likely to do from here, we're fortunate to speak today with Brent Johnson, CEO and Portfolio Manager at Santiago Capital and developer of the Dollar Milkshake Theory. Brent, it's great to see you again. Thanks so much for joining us today.
Yeah, thanks for having me. This should be fun.
Hey, it's always fun, Brent. Look, lots to get into. I do want to dig into that startling comment I started this off with about basically Americans having just lost a quarter of the purchasing power of their money over the past 4 years. But before we dig into that, a couple other things that are important to discuss first, namely, I'd love to start with a revisitation of your dollar milkshake theory. It sounds like these days there's a lot of people putting words in your mouth, sometimes inaccurately, maybe sometimes unfairly. So I'd love to give you a chance to just take a few minutes here, or however long you need, to clarify your dollar milkshake framework for folks.
Sure. So, well, first of all, thanks for having me on. Thanks for giving me the opportunity to clarify some things. So the dollar milkshake is essentially a framework for how I see a sovereign debt and currency crisis playing out. Now, when I first mentioned this, it's funny, it's almost exactly 6 years ago that I first mentioned this. It was in the summer of 2018. I did kind of a long form interview with Real Vision, and that interview is still available. And the reason I say that is because anybody who wants to check can go back and see whether or not what I'm going to say now is the same thing that I said then. But again, the milkshake is essentially a framework for how I see a sovereign debt and currency crisis playing out. I thought that we already would have had one. And in my business, getting the timing right is the difference between being right and wrong. And so I'm happy to say that, or I'm willing to say that I got the timing wrong. However, what to me, what's been extremely helpful is that the framework that I laid out and the kind of predictions that I made as far as what markets would do in that environment has largely played out. Now, it hasn't been perfect, but it has helped me understand what is going on in the world and why what is happening is happening. And what I essentially said, I said there was a couple specific things I said back in that initial interview, and that was from a market perspective, I thought that the 40-year trend of interest rates going lower would end. So I said interest rates would head higher. So that long-term chart of the 10-year bond interest rate going lower and lower and lower, we would break out to the top side of that. And when that happened, then bond prices would break. So bond prices would fall. And when bond prices fell and interest rates rose, that would actually be good for the dollar, because now you would get paid more to sit in the cash of the country that had the global reserve currency. And the interest rate mismatch between what the US was paying and what the rest of the world was paying would be one of the factors which would help draw capital into the United States. And so as a result, the dollar would go higher. That in itself was not so controversial. But what I then also said was that despite the dollar going higher, which is often seen as bearish and deflationary, I said that US equities would go higher as well. And I said gold would rise as well, and that we would eventually get into an environment where both the dollar and gold, which I classified in that interview as two currencies, that those two currencies would rise together versus all of the other currencies. And in general, I said that the United States economy and the United States capital markets would outperform the rest of the world. Now, if we go back to the summer of 2018 and we look at the price, we look where bond prices were, we look where the dollar was, we look where US equities were, we look where gold was, all of that has basically been true. Interest rates have gone much higher, bond prices have gone much lower, the dollar is much higher than it was at that point. US equities are much higher than they were at that point. Gold is much higher than they were at that point. And the United States has largely outperformed the rest of the world. Now, what I also said at that time is I said I would try to walk everybody through it somewhat linearly because I think humans in general understand things better in a linear fashion, or at least they think in a linear fashion. But I also admitted at the time that I didn't know exactly in what order these things would play out. And it wasn't necessarily a linear progression. Some of them could happen at the same time. One might happen before the other. I didn't know the exact order, but these are just the things that I thought would happen. And as I fast forward 6 years to where we are now, again, it's largely been the case. I do think, like many people, that COVID in many ways kicked the can down the road on many problems. When COVID first happened, I thought that would potentially be the trigger that would cause this global sovereign debt and currency crisis. But subsequently, as I look back and figure out why that wasn't the case, I think it's because at the time, the US was still largely, not as much as maybe 5 or 6 years prior to that, but at the time was still cooperating. There wasn't as much geopolitical confrontation. There wasn't as much domestic confrontation. And the world was, in general, a nicer and happier place. And as a result, as they were faced with this global pandemic, they largely cooperated and worked together to try to solve the problems. I don't think that is any more the case. So in other words, they were able to kick the can down the road because of coordinated action, coordinated policy, working together to get things back to normal. But now we're in a situation where globalization is no longer the popular thing. Rather, economies are retreating into their domestic economies. There's no longer one supply chain. We're going back to two supply chains. Battle lines are being drawn literally and figuratively amongst geopolitical blocks and trade blocks. And so I do still think that debt has consequences. And when I think that debt problem manifests, it won't be as easy to kick the can down the road as it was last time. So anyway, I think that's probably a long explanation. But one last thing I would say is I never said that the US dollar was a good currency. In fact, I'm pretty sure I said it was a pretty bad story or a pretty bad currency. And I never said that this would be good for the United States. I just said it would be better for the United States than the rest of the world. It's always been a relative argument. And I also said it's a story that ends very, very badly. So this wasn't the Pollyannish view where you don't have to worry about anything. You just go buy U.S. assets and everything's fine. That's certainly not the case. I think the world has a lot of problems, but the world is what it is, and the U.S. does have the biggest capital markets. I do think that for many reasons, some deserved and some undeserved, that capital will flow to the United States in a crisis because it is the best option out of a bunch of bad ones.
Okay, so let me put some parameters around some of this stuff. So when you talk about a sovereign debt crisis and a currency crisis, I don't think you're talking about a bad year or a couple bad years and then we get back to status quo. It seems to me that you're talking about here that these are going to be transformative events that will either rejigger the balance of power economically, geopolitically, or maybe lead to new currency regimes. Is that true?
Well, yeah, yes, and yes. The short answer is yes. I think what's important to point out is that this is a process.
Mm-hmm.
I think in today's day and age, especially for the younger generation, everybody is so now not only wanting immediate gratification, but in many parts of their life, they're able to get immediate, gratification. And so when I go to conferences and when I'm, on these podcasts and when I interact with people on social media, I feel like, and perhaps I'm wrong, but my impression is that many people think we're going to have this really big event sometime in the next 6 months to a year, and then it's all going to be over and we're going to be on to the next thing.
Yeah, and just so you know, that's exactly why I'm asking this question, is to give you a chance to dispel that if that's true.
Yeah, so I think that's totally wrong. I think what I am describing, again, when I first started talking about this, I said I thought in the next 3 to 5 years it would happen, and it didn't. And I'm now saying I think it's going to happen in the next 3 to 5 years. But I'm the first to admit that if I'm wrong, I think it'll probably take longer than that rather than shorter than that. Now, the other thing I'll say is that it's possible that we do have a huge event sometime in the next 6 months to 12 years. And that is severe enough that we are then on to the next thing. I don't think that's the case, but I cannot rule that out. So because I cannot rule that out, I have to be ready for it now. But I also don't think that you should necessarily allocate your entire portfolio to this crazy big, huge event happening in the next 6 to 12 months. I do think that this is going to be, I've compared it many times to the Game of Thrones. And, in the Game of Thrones, sometimes you win a few battles, then you lose a few battles. But it's 7 or 8 seasons long. And, many times in the first season, you're like, wow, this is almost over. But no, it goes for another 7 or 8 seasons. So, and I think that's largely what this is going to be. The market. And that's the other thing is, I think a lot of people, again, I think this has a little bit to do with the gamification and this immediate gratification. They think if you say, stocks are going to go higher, they need to go higher in a straight line forever and without any deviation along the way. And markets just don't work that way. They move higher, they pull back, they consolidate, they go higher, and maybe they have a hard pullback and then they go higher, and then maybe down the road there's a big come to Jesus moment where they fall. But in general, markets don't trade in a straight line. And so, again, I am of the opinion that we have a current monetary system. And I think in the years ahead, we will transition to a different system. Now, I don't think that's an outlandish statement. I think most people will agree with me, or many people will at least understand that as a possibility. And it's not that I don't think that the system can change. Again, I think the dollar is going to get much stronger. And so sometimes people will think that I never think it can end. Well, it absolutely can end. But I guess my point is we have a current system. We will potentially transition to a new system. I do not think that during that transition period, it will be economically peaceful or militarily peaceful, unfortunately. I think this transition that many people foresee from the current monetary system to another monetary system will be not only economically volatile, I think it will probably be militarily violent, because that's typically what happens. And I also am of the belief that money in many ways is a manifestation of power. So to have a completely different system than what we have now, in some form or another, the people in power or those who are deciding what kind of system we have will have to change. And I can't rule out the fact that it won't be the United States making that decision for the new system. What I feel very strongly about is the United States will not just roll over, walk away, and let that new system come into being without them having a say in it. And if it isn't going their way, I don't think they will play nice. is probably the right way to me to describe that.
Right. Power systems, regimes, they don't usually willingly give up power, and they
Right.
usually do everything they can to protect it, right? So
Right.
you mentioned sort of Game of Thrones as your analogy for this. I'm going to throw another one in, which is this is not apocalypse now in terms of sort of how you're looking at it. It's more like a series of unfortunate events, right?
Yeah. That's a good way to put it. That's a good way to put it. And I am the first to say that a lot of these unfortunate events, I think, will happen as a result of the United States making many mistakes along the way. I don't think this is a situation where the U.S. has done everything right, the rest of the world has done everything wrong, and as a result, the U.S. is going to come out ahead. I think in many ways, the U.S. has done many things wrong, but because the system is designed the way it is, and because the United States, for whatever reason, whether it's, again, manifest destiny or just luck of the draw, from a geographic perspective, it can be largely self-sufficient. It's not currently self-sufficient, but it has the potential to be more self-sufficient than any other region in the world. And so again, on a relative basis, that's a pretty attractive attribute to have.
Okay. So just to again clarify a couple of things you said throughout this series of unfortunate events, at least up until sort of the last chapter, you expect the US dollar to strengthen. I think what you meant there was relative to other sovereign currencies, relative to real things, different story, right?
Yes, that's correct. But I put a caveat on that, and this is where it's important to understand how the system is designed. And if you don't mind, Adam, I'm going to do a shameless plug here.
I don't mind at all. Plug away.
So forgive me. So I have spoken about this on numerous podcasts, given several presentations at conferences, many interviews, interacted with people on social media. And under the best of circumstances, when I do that, even like today, you're giving me carte blanche to just spend a lot of time really focusing on this. That at most these things are typically an hour, right? But the reality is I could probably speak an hour on 6 or 7 different topics related to this thesis.
Mm-hmm.
And I will often say things like, well, in order to understand this, you have to understand how the monetary system works. Well, again, I could spend more than an hour just explaining how the monetary system works and how it's designed. But I typically don't have the opportunity to do that. So what I've decided to do is later this summer, we haven't figured out an exact date yet because we're managing the logistics of a few travel schedules. But at some point later this summer, probably in August, we're going to do a one-day event where we're going to do a deep dive on the milkshake theory and spend a lot of time on a number of these different factors that go into why I think the way I think and why I think what will happen will happen. And if anybody's interested in attending that or being part of that, the best way to do it for now is to send an email to masterclass@milkshakespod.com. Again, masterclass@milkshakespod.com. And if you send an email, then you will be on the list that will be one of the first to get the more detailed information once we have it. But the reason I brought that up right now, Adam, is because to answer your question, I'm going to have to say something like, well, you have to remember that the monetary system is a debt-based system.
Mm-hmm.
And so in a debt-based system, it has to grow. And as the money supply grows, typically fiat currency loses value. That's kind of a harbinger of fiat currency, and that's not unique to the United States. And so over time, one of the reasons people invest is over time, humans are typically innovative and come up with better way to do things, and that produces economic growth. And as a result, asset prices rise. But the other reason asset prices tend to rise is because current fiat currency tends to lose value.
Mm-hmm.
And that includes the US dollar. And so, yes, to your point, as we move forward in time, I'm not necessarily saying that the dollar will hold its purchasing power versus real things, but that it will rise. And again, this won't be in a straight line either. The dollar will go higher, it'll pull back, it'll go higher, it'll pull back. It won't be a straight line, but in general, the dollar will rise versus other fiat currencies. The reason that is important is in a debt-based monetary system, especially in a debt-based monetary system where the entire world uses dollars. And let me just I'm going to do a little tangent here. A lot of people know that the United States owes like $35 trillion now. What most people don't know is that the rest of the world owes even more than that in dollars. And they don't owe it to the United States, they owe it to each other. So the debt problem that the United States is facing is also being faced by the rest of the world. The difference
and
is
oftentimes are worse, right? Because
and oftentimes worse.
They don't have the ability to print dollars and ease their debt burden.
That's exactly right. And so when the US dollar rises versus other fiat, even if all fiat is losing value versus real things, if the US dollar rises versus those, because those other countries also have US dollar debt, as the dollar rises, it makes it harder for them to service that debt. And if and when they are no longer able to service that debt, that is the situation in which you get a credit crisis or a credit crunch or a contraction of the money supply. And that is why, even though over long periods of time, assets go up and to the right, you will experience along the way terrifying drawdowns. I don't care if you look at a 10-year chart, a 20-year chart, or a 100-year chart. Even if that chart goes up and to the right, there will be periods of time along there where you will have very hard drawdowns. Those very hard drawdowns almost always coincide with a contraction of the money supply. And so when the US dollar goes up versus other currencies, that creates the conditions. It doesn't guarantee it, but that creates the conditions in which you get these hard, terrifying drawdowns. And that is why it's important. And that is why you can go from a situation that is inflationary and fine to a situation that is deflationary and not fine very, very quickly. It's the whole, elevator up or stairs up and elevator shaft down, right? You climb, and then all of a sudden you give away all the gains in 3 days or whatever it is. That's partly due to the design of the monetary system. So going back to your question, in general, I think in the years ahead, asset prices, especially in the United States, and commodity prices will probably rise, but there will be periods of time where you will get these sharp drawdowns. And so I don't think a lot of people will tell me, well, fiat is getting debased, fiat is going to die, so all you have to do is buy hard assets and not worry about it. Well, if you have a long-term time horizon, and if you have liquidity from another source other than your portfolio, that is true. But that doesn't mean you won't experience very hard drawdowns along the way. I'm going to give you a quick example before I forget about it. Let's pretend that you and I were at a conference in April. And at this conference, several speakers got up and said, the age of fiat is over. The central banks are going to have to print like crazy to solve all these problems. As a result, the fiat currencies are going to continue to lose value. And your best bet is to go buy gold, silver, oil, copper, and many other of these hard assets and just let them inflate away the debt. So if we did that towards the end of April or middle of April, we'd probably be pretty happy because over the next week or so, those would have gone up in price. But then over the last 2 or 3 weeks, we would have gotten our heads smashed in because each of those have pulled back anywhere from 5 to 20%. And over a week to 2 week period. And again, nothing has really changed other from a month ago. We're still in the same type of environment, but you get these hard drawdowns along the way. And again, if you have a long time horizon and you don't need liquidity, then that's totally fine. But you need to be aware that those things can happen. And you can't, if you put all of your money into that trade, when you do get these hard drawdowns, all of a sudden, rather than being a distressed buyer, you are the distressed seller.
Right.
And so, I talk to a lot of people who, they understand this about fiat currencies. They understand it loses value. And they've got 60, 70% of their portfolio in gold or, hard assets of some kind. And that is a huge position. I'm not saying it won't work out, but it's very risky as well. Any kind of concentration in any one thing is risky, regardless of how much conviction you have.
Yeah, absolutely. And I mean, anybody that's involved in the commodities markets, the precious metals markets, you need to enter understanding that they're volatile, right?
Yep,
And in human beings being emotional and having a revolutionary wiring, unless you really fully have entrenched that volatility into your expectation set, you get a price decline. A lot of people get shaken out, right? And
yeah,
so they end
right.
up, selling at the wrong time. It's also important to note, and you've mentioned this many times, you can have, financial episodes where, an asset class like equities gets pulled down into some sort of big correction or vortex, right? And as a result, the hard assets start selling off because people are getting pressured with margin calls, and you just have to sell
That's right.
whatever collateral you have. Even if the trigger is not hard asset related, the hard assets can actually get injured by some of the repercussions going along in the series of unfortunate events that you've mentioned. So again, just
That's right.
underscoring, diversification is always, it's a time honored best practice for building wealth, and even for people who have strong conviction here. Being majority or 100%, in any one thing is usually not terribly wise. All right, a couple of things. One, when I edit this, Brent, I will put up the link to that masterclass at Milkshakes Pod email on the screen, so folks know where to go. Folks will also have a link in the description below the video too. I
Thank you.
suspect a lot of the viewers here, Brent, are want to go watch that. Um, I just want to make sure people understand something that you're saying too, which is I think people hear dollar milkshake theory and they think, okay, this framework applies to the dollar, the currency. It's all about the currency. And, I think what you're saying is no, 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 you got to think about it bigger than that. Yes, the framework sort of predicts what will happen with the currency, at least on a relative basis to the other ones, but it's also economically that the advantage that the US has from the dollar will put the US likely in a superior position to the other players on the chessboard, such that as capital begins to get worried around the world, it will flow into the US, and that is going to benefit the US economically. It's going to benefit our financial markets. It's going to be an unfair advantage that we're going to have in this story. You're nodding as I'm saying this. I'll take a pause in just a second. But in addition to it, it's also geopolitical and a story about resources where the U.S. has it's got the biggest bat on the block, right? And as you've I think as I've heard you say many times, it's going to use it when it has to, and it's
Yeah.
still got plenty of tricks, maybe a number of them dirty, that it's gonna pull in this fight as the competition for global resources, global economic hegemony, whatever unfolds here. So as things get more and more fractious between the different players on the board, the U.S. is going to use all of those advantages, including its geographic one, which you alluded to, which is we've got a surfeit of resources per capita relative to most other countries. We've got two major oceans on either side. We've got friendly nations above and below us, where we've got a very attractive position on the global chessboard. And part of what you're saying is yeah, there's stuff that's going to go on with the dollar itself, but there are all these other factors as well that play into the story.
That's absolutely right. That's absolutely right. And again, I think oftentimes I will get labeled, the American exceptionalist, or I think the United States is a better place than everywhere else, or that we're smarter than everybody else. And, I've been called jingoistic. I've been called, a simp for the US government, like all this like silly stuff. Right. And again, I don't necessarily like, I have to tell you this, when I kind of first kind of figured this out, to the extent I have figured it out, when I kind of first stumbled upon this idea or this framework, part of the reason I knew that I was on the right track was that I hated the answer. I hated it. And I didn't want it to be true. But the more I studied it, the more I realized that it was. And so I think it's important to understand that, analyzing something doesn't mean that you agree with something or disagree with it. It just means you recognize it for what it is. And again, I think a lot of times this is this is one of the bigger mistakes that I see people make is they will allocate their portfolio in a way based on what they want to see happen rather than just being really ruthlessly, objective about it and figuring out what's actually going to happen. And, in many ways, if I could design the system, I wouldn't design it this way. If I could, push a button and change things, I wouldn't have everything stay the same. But, I've spent countless hours on this stuff. I've been thinking about this stuff for hours every day for the last 15, 20 years. So, I don't know what that adds up to, but it's a lot. And I've tried many different ways to kind of figure out a way out of this that doesn't involve great chaos and great, unrest. And I just can't do it. I can't figure out a way out of it. What I can see, I can see the can just being kicked down the road continually for another 10 or 20 years, right? I can see that easier than I can see this being resolved in a peaceful and calm manner.
Okay. And I think that last point's really important because I know you do too, Brent, see a lot of people who are understandably very worried about the state of their national currency, but a lot of Americans are extremely worried about the state of their own, right? I kicked this off mentioning the 25% decline in the purchasing power of the dollar for the past 4 years, right? And so there's a lot of, obviously that's very emotionally charging for people. It puts a lot of fear in people about their ability to provide for themselves in the future. And as an investor, it can oftentimes influence people to take really extreme positions that like, okay, so the dollar's dying and I got to take positions today to protect against it, right? And, I think a big thing that you're saying, and you're a guy who's probably thought more about this than almost any human on the planet, and it has lasted a lot longer than even you thought, the general status quo has, right? And I think a big warning you would tell folks is, look, it's likely not just going to be one big event, and it is probably more likely to be a series of these events that takes place over years, probably decades, and not necessarily something that's going to, just happen in the next, whatever, couple of months or quarters. And therefore, don't put all your eggs necessarily in this basket, especially in a way that if it doesn't happen on a short-term timeline, you've really injured yourself, right? Worst case scenario, you might have been too conservative and missed out on upside. But I've know as you probably seen like I have, I've seen people that have put all their money into certain assets or gone short, right?
Yeah.
And then the reckoning didn't happen on their timeline, and they're wiped out.
No, that's absolutely right. And the other thing I want to say before I forget is that when talking about we've talked about the US dollar losing its purchasing power. And it has. I'm not denying this, and I'm not making excuses for fiat, but I want to point this out because I sometimes think that just people don't understand this, is that if you are not an American and you live somewhere else around the world and your domestic currency is not the US dollar, holding US dollars has been a lifesaver for you. And in many countries around the world, the US dollar has not lost purchasing power versus goods and services in their local economies. And I don't think people realize that. And so my audience and my client base is not just United States. I have clients in Asia. I have clients in Europe. I have most of them are in the United States, but they're not just in the United States. And my audience of, not even my clients, but just my audience, the people I talk to, the conferences I go to, I don't just go to conferences in the United States. I don't just talk to people in the United States. When we do our weekly show or when people watch this show, there's people from all over the world that tune into this. And for those people who have held dollars, not only have they made money versus their local currencies, but they've gotten paid much more to do so because of the interest rate. And so again, I kind of laugh when people tell me fiat versus fiat doesn't matter, and I'm an American exceptionalist, almost without fail. This is from an American who has never traveled or never done business abroad and who doesn't understand that fiat versus fiat actually does matter. And they are the American exceptionalists because they don't think relative currency levels matter to anybody except a currency trader. But it actually does matter. And currency versus currency, or fiat versus fiat, is probably the single most important variable in global finance. If you get the dollar versus other fiat wrong, It's hard to get the rest of your portfolio right. It's not impossible, but it's hard. And so, and if you're somebody who thinks that markets are broken and they're no longer efficient and they're totally, manipulated by governments, and as a result, you don't want to participate in them, listen, that's a totally legitimate view. I get it. And if that's what you want to, if you want to exit it, that's totally fine. But that's not what I do. I am involved in markets, right? And so if you are participating in markets and you do like to trade things and you do invest in things that are not just hard assets that you can store under your bed, then you need to understand these types of things. And if you want to try to profit from relative levels of different asset classes, you need to understand the influence that fiat versus fiat has on those different assets.
Okay. I do just want to let folks know, as we get near the end of this discussion, Brent, I am going to ask you, how are you allocating capital right now, given this outlook?
Sure.
I know you've shared your allocation in interviews past, and maybe you're just doing more of the same, but we'll get to that. I'll scratch that itch for folks because I'm sure that's a huge question folks are asking themselves. All right, so great distillation of the framework. I've got a couple related questions to ask. Before I do, is there anything else about the foundation of the framework you want to say that we haven't talked about yet?
No, I think that's a pretty good basis.
Okay. All right. So let's talk about the US dollar versus other fiat currencies. What is the current dynamic in play right now here in 2024? And peering into your crystal ball, what do you see as more likely to happen over the next, say, 6 to 12 months?
Well, first thing I'll say, the next 6 to months are just, it's a crapshoot. I mean, I mean, we've got so much coming up over the next 6 months, whether it's potential rate hikes, whether it's more stuff going on in Europe with Russia and Ukraine, further, things with China and the US, and then not to mention the presidential election, right?
Yeah.
So I think the next 6 months are very hard. This is what I'll say, is that when I look at markets are, and again, before I get started, let me say this. I have never told anybody to just go put all their money in dollars and sit there. In fact, I think a lot of people think that the dollar milkshake theory is just the dollar goes up versus everything. That's not the case. It's just that the dollar is the driver of all the different asset classes that we invest in, right? And so I think when I look at markets and I look about how to allocate assets, I see Bitcoin is near its all-time high or at its all-time high. Equities are at or near their all-time high. Gold is at or near its all-time high. Silver is at or near the highest level in 5 years. And when I look at, the put-call ratio as an example, nobody's buying puts, everybody's buying calls. It's not at its low, but it's near its low.
Right.
When I look
credit yield spreads are
right.
near historic low. Right.
That's right. Credit spreads are very tight. They're near their lows. When I look at the volatility in the VIX, and many people think the VIX is dead, and I understand that argument. But regardless, vol is at or near its all-time lows. And so I don't know that we're going to have a crisis in the next 6 months. I don't know that this is a really bad time to be involved in the markets. All I know is that the table is set in a way that if some unexpected event or even some expected event happens and causes even a little bit of chaos, markets could easily reprice from their current levels. I do think that obviously going into the election, sorry, the monetary authorities, the government of the United States, they're not going to want chaos leading into the election. They're going to want things to be relatively smooth. And as a result, I would expect them to try to make moves to keep it that way. But the other thing I would say is that's always been the case in leading up to every election. And if you remember 2008, we had a global financial crisis leading right into it. At one point during the 2008 campaign, McCain and Obama even discussed, putting a temporary pause on the campaign so they could go back to Washington and deal with the credit crisis and deal with the banking crisis.
McCain actually, I think, very visibly did go back to Washington.
Yeah,
for a while.
I think that's right. I think that's right. And my point is that central banks, monetary authorities, governments, They're extremely powerful, and they can do a lot of things, but they are not infallible. And just because they don't want something to happen doesn't mean that it won't. And so as I look at markets, the reality is I think you asked me earlier, what was my current view of the current global economy or global market? And I don't know if I actually answered it or not. So
Actually,
I'll
I
kind of,
hadn't asked it to you yet,
okay.
but
Okay.
let's get there right now.
Well, it kind of relates to this. So I would say the state of the economy right now is, I guess the right word I would use is fine. I mean, you know, stocks are at their highs, unemployment is low, the volatility is low, inflation is coming down, or it's at least it's not rising as fast as it used to be. Things are on the right track from a high level, right? Now, when you start to dig in a little deeper, maybe everything doesn't look as good. But I'm just saying, in general, things are fine right now. But again, going back to the design of the system and going back to the fact that I just mentioned that all these asset prices are at their all-time highs and VIX is at its lows, there's no fear in the market and everybody's very kind of sanguine and calm. To me, that is the time where you want to kind of step back and say, hey, I don't necessarily need to sell everything right here. I don't need to like check out and go move to a mountaintop and come back in 10 years. But this is probably a time to have a little bit of insurance on the sideline, whether you're protecting your portfolio via some kind of hedges, whether you have cash on the sideline to deal with it, whether you start to take profits on some of your investments. You kind of have to figure that out for yourself. And I'm not predicting an imminent crash. I'm just saying many of the things that I look at tell me that if we had any kind of uncertainty enter the market, things could reprice very quickly. And so, as I look over the next 6 months, I see a number of things that could take vol from 12 or 13 to 20 or 25. Now, that in itself is not the end of the world, but it could put pressure on asset prices. So my guess would be that we are either at or near the highs for asset prices for the year. It would not surprise me at all to see them trade sideways going into the election or even trade down into the election. I do not think we are going to have a melt up into the election, but I will also say that is not impossible to happen. I could make an argument for that to happen. I'm not positioned for a melt up into the end of the year, but I'm also not 100% in cash waiting for a big crash. And so this may sound a little wishy-washy, but here's the thing. I think it's okay to be wishy-washy. You don't always have to have a huge bet on. And in fact, most of the time, you should not have a huge bet on. And if and when you do have a huge bet on, it should probably be against consensus rather than with consensus. And so, to me, not only over the next 6 months, but I would even say over the next 6 years, the number one goal for me and my clients, and what I think should be the goal for most people, is survive in advance. Again, I don't think you need to hit a home run every time you step up to the plate. Just get on base, just don't strike out, just kind of make progress. If your friends get up there and hit home runs day after day and you're hitting the, singles and doubles, you know what? Maybe they're getting all the accolades, but you know what? You're doing just fine as well. But sooner or later, those guys that are hitting the home runs, they're going to strike out. And if you can keep hitting singles when they're striking out, over time, you're going to do pretty well. And so, I don't, this is, again, going back to your question, I think everything's are fine right now, but I can paint a number of scenarios that could turn things not fine pretty quickly. And as a result, I'm conservatively positioned right now.
Got it. All right. Well, I hear you say,
Probably as conservatively positioned as I have been in a long time.
okay, that's a very important qualifier. Yeah, so what I hear you saying is, look, they're called extremes for a reason. We're seeing a lot of extremes right now to the upside, just sort of the math of mean reversion, as well as just the environment of potential triggers that you've spent the past 40 minutes talking about are all out there. So unless you've got a massively confident conviction play, which it doesn't sound like you have right now, is more of a time for safety, as you said, prioritize, what was it, survive in advance?
Let me give you a quick example, because this is something, again, this is not a recommendation. I'm not telling you should do this. I'm just giving you an observation. If because of the way things are priced right now, again, let's just use the S&P. For the S&P 500, I think today is either at or near its all-time high. The VIX is at or near its all-time low. I think, I haven't looked this morning, but I think you can buy a 1 year, 1% out of the money put. Maybe it's 1 to 2% out of the money put on the S&P 500 for like 1.5% of your overall portfolio. And so in other words, if you spent 1.5% of your portfolio on puts on the S&P, you know, a year out, 9 months to a year out, 1 or 2% below these current levels, I think it would cost you like, to me, it's worth spending 1.5% to protect against a large decline. Now, again, I don't know whether that decline will come or not. I'm just saying, if you're going to buy insurance, you do it when it's cheap. And right now, it's not often much cheaper than it is right now.
That's a great point. I'm going to flag to talk about that with the New Harbor guys because they're super into hedging and, you know,
if you give me a second, I'll tell you exactly what it costs.
All right. Well, look, while you're pulling it up, let me just commend you for a good analogy, another good analogy, which is as you were talking, I was thinking about, you're sort of describing the true Moneyball, right? You know, you remember the movie Moneyball where the logic there is they find out that, yeah, everybody is fixated on the hitters who have really high batting averages, right? The guys that hit more home runs than most. But they realized that, hey, the key factor, which at the time nobody was looking at, was sort of the on-base percentage. You know, does this guy actually get on base one way or another and end up, scoring a run for the team, right? And it's not necessarily the heaviest hitter, but it's the guy who gets walked most often, or the guy who consistently can, hit singles and get on there and then be in a position to score. And you're basically sort of saying the same thing, right? Which is, if you can take a lower risk strategy but get more on base percentages in your trades, over time, you're going to outperform.
Yeah, and I think that's what you have to decide, and everybody has to decide this for themselves. Not everybody's goal should be the S&P 500. I mean, if that's what you choose, that's fine. I'm not telling you that's wrong, but I'm of the belief that a lot of people will use the S&P 500 as their barometer or their benchmark, even though there's no. I mean, it's kind of a random thing that says, I'm going to beat the index in stocks, but that might not be the most appropriate thing for you.
Right, and starting up, but that also comes with the risk of attaining that return.
No,
right?
Exactly.
So we talk a lot on this program with our endorsed advisors about the key thing is to come up with your plan and figure out what goals you want to hit by when, and then figure out how much risk you need to take on to hit those goals. And in a lot of cases, it can be a lot less risk than if you're trying to even meet the market, right? And if That's so, right. Then hey, don't get distracted by the folks that are out there swinging for the fences. Just bunt and get a single and a double and get some walks and get there with a lot more safety.
Yeah. So I just, by the way, I just looked this up while we're talking. It's a little bit more expensive than I thought, and it kind of depends whether you're using futures or equities. But in general, if you go out 9 months from now and you buy a put 2% out of the money on the S&P, it'll cost you a little over 2%. So again, it's not quite as cheap as I was saying, but it's still, but that's the types of things you think about, right? Would you be willing? So let's say you did that. And let's say over the next year, stocks go up another 20%. And then since you spent 2% on insurance, you're up 16, 17, 18%. So you trailed a little bit, right? Well, if you're up 16 or 17%, and the market's up 20, it's not like it's not horrible, right?
Right.
But the flip side is that if the market goes down 20%, you're down too, right? So I mean that's kind of how you have to think about it, or at least that's the way I think about it, and I think that's the right way to think about it. Again, it's kind of the tortoise and the hare, slow and steady wins the race. Now you're not going to become the richest guy in the world investing like this unless you have a very long time horizon and just keep compounding your returns. Then you could, but the point is you don't always have to win every race. You just have to not get killed every now and then. You're going to make money over time by not experiencing 30 or 40% drawdowns than you are by getting 30 or 40% to the upside every year.
All right, very well said. All right, well, look, I'm looking at the time. I want to get a few more questions in here before we wrap it up. Maybe I'll try to combine two here. So again, getting back to how much purchasing power has been lost in the dollar, for Americans watching this over just the past 4 years. Um, what is your counsel to people who are, understandably very concerned about that? Nobody knows what's going to happen from here. Hopefully, the pace of the devaluation slows down here a bit because we're not doing these massive multi-trillion, rescue packages, at least at this point in time. Um, uh, but for people that are saying, yeah, look, I really am worried about the devaluation of the currency. Um, what kind of things would you encourage them to consider? And if relevant, jujitsu your answer into how you are currently positioned for the current market environment and your current outlook.
Yeah. So the first thing I'll say is I'm long a bunch of equities for my clients because I've had many of my clients. I have a few that are, a couple of years old, but most of my clients I've had for 10, 15, 20 years. And so we've owned equities and many times the same equities for literally almost all of that time period. And so we don't sell, we don't move in and out of the market that often, if ever. But what we will do is from time to time, if we think prices are really low, we'll buy calls, try to get some leverage to the upside. If we think they're overpriced and due for a pullback, we'll buy some puts for the downside. So we'll control exposure via, equities or derivatives, derivatives or options, however you want to describe those. And so we are long equity. So if we get a melt up over the next 6 months, we will participate, but we will trail the market. We also have a fixed income allocation, which is very short duration. I think the longest bonds we have are maybe 2 to 3 years, but even that is pretty small. We have a fairly high allocation to T-bills right now. And the other thing I need to say this because I'm regulated, by the way. I'm not saying this to try to be,
Yep.
cute or funny. Like I have to be careful what I say because I am regulated, and I have to say not all of my clients have the exact same portfolio. I customize all of my portfolios to them specifically. So I'm kind of speaking in general terms here. But for a lot of our clients, we have either money market funds, which are now paying close to 5%, or short-term T-bills that are paying 5% or more. We think that's important to have. We have clients we have anywhere from, again, it changes from client to anywhere from 5 to 25% in gold. And I know that's a big range, but some people want more gold, some people want less, but all of our clients own gold. And here's the thing and people have often said, well, Brent, with the milkshake theory, you said gold would go up last and that the dollar would go up first. Again, I don't know exactly how these are going to play out, but I think gold is going to rise over time. And just even if I think gold is going to go down, I still own it. And I'll give you right now, I think gold and silver are due for a pullback. They've already had some pullback. I think they will probably pull back more, but I'm not going out and selling all my gold because I think the price is going to go down. I own gold whether the price is going up or going down because I think it's a key part of an overall diversified portfolio. And I own it for insurance reasons and the fact that it can't be deflated away and it can't be inflated away. So for all the reasons that many other people own gold, we own gold. Even if we think it might fall from time to time, we still own it. So we own that. So that's an important allocation. All of our clients, we have pretty substantial holdings in real estate. I kind of feel like real estate's a little overpriced now and would probably, as resets continue to happen and interest rates are higher, I think it's likely that real estate prices come down, but I'm not a huge real estate bear. And I think in some case, other than commercial real estate, I think commercial real estate, there's a lot of reason to be concerned. And I think we will see a lot more. I think we will see a lot more pain in the commercial real estate area. And as a result, the banks will suffer, especially the regional banks. But as far as home prices themselves, I think they're likely to come down, but I'm not anticipating a 2008 type reset in housing prices. Yeah. As ever, you can't rule it out, but that's not a core thesis of mine. And so those are the four main asset classes: short-term fixed income, equities, real estate, and gold. Now we do one area of commodities that I am fairly bullish on is the soft commodities: wheat, corn, soybeans. We've seen things like cocoa this year kind of got into a supply crunch, and the price has gone up a lot. I started buying the ags last August, September. And, for the first 6 months, they were below water. They've now kind of risen back up to kind of where I bought them. But I think that's an area where we could see some significant price appreciation. So we do have holdings in agriculturals.
All right. And real quickly, why? Is it for just because they're commodities that as well in a devaluing dollar,
yeah,
or is it because of world demand or supply issues?
I think all of it. Due to some potential weather patterns and weather cycles, I think we could have some lower crop yields, which could lead to a supply imbalance. Also, geopolitical issues with the grain coming out of the Black Sea and out of the Ukraine or out of Ukraine. We could see supply issues. And just typically, when geopolitical issues flare up, commodity prices tend to rise. That's part of it. And then part of it is, people are continuing to be born and people have to eat, right? And so I think that's part of it as well.
All right. This has been a great conversation, and having the update on the dollar milkshake theory, super useful. Of course, it unlocks a whole host of other, you mentioned that you could speak for an hour on like many of the multiple pillars that underlie the framework. I've got a number of questions here I'd love to ask you, but again, we would need several more hours. So Brent, we'll just have you come on back. And obviously we'll have you come on back when your conference is coming up, so that you can give us an update on your general outlook, but you can also tell folks the specifics of the conference. All right, so as we wrap things up here, a couple important questions for you. First is, for folks that would like to follow you and your work between your next appearance in the future here on this channel, where should they go?
Well, we do a weekly show called Milkshakes, Markets, and Madness. You can look that up on YouTube. We have a Twitter account for that. It's called @MilkshakesPod. My Twitter handle is @SantiagoAU Fund. I'm pretty active on Twitter. But we'd love to interact with you on those platforms as well. And again, I appreciate you having me on here to give an update.
Well, yeah, like I said, I mean, if it wasn't abundantly clear before, Brent, the door here is always open to you to come on anytime you feel you've got something important to tell folks here. Look, so we'll have you come on to remind folks about your conference. And again, folks, I'll put up the URL here. Again, was it masterclass at milkshakeswithanspod.com?
That's right. That's right.
Okay, great. And I'll have them on the screen too.
And I think, I think the big message I would want people to leave this conversation with, and if you see me, on other platforms, or if you see me talking on Twitter, it's not because I want to convince everybody that I'm 100% right. And it's not that I want you to sell everything you own and go buy dollars. The reason I'm pounding the table is to kind of counteract a lot of the silly or inaccurate things that I see on those platforms. And I'm trying to get everybody not to bet 100% that I'm wrong. I don't want you to bet 100% that I'm right. Just don't bet 100% that I'm wrong. Because if I am right, that's going to mean dramatic things for your portfolio.
All right. Well, very much appreciate that. Okay, so a couple real quick things. One, I've got one last sizable question for you, which we'll get to in about 30 seconds, which is, what's a big lesson that you've learned through the course of your successful career, Brent, that you think is worth sharing with the audience? Before we get there, I just want to note, speaking of thoughtful money, I've shared with the audience here that we've picked a date for our fall conference, which is going to be Saturday, October 19th. You very kindly agreed to speak at that conference. So Brent, thank you for that. I'm sure probably we'll have you on this channel back before then, but very much appreciate you participating in that all-day event. All right, Brent, we're at that final question. Yeah, if you've got one, what's an important, valuable lesson or insight that you've gleaned in your decades of success and what you've been doing?
Well, I've got two of them, and I'm going to give you two because I can't decide which one is more important. And I alluded to one of them earlier, and that is, if you're trying to change the world, and I think that's a hugely, important and, honorable goal to have. But if you're trying to make money in your portfolio, I think the goals are a little different. And what I mean by that is, if you're trying to change the world, then you have to do and maybe take some risks and do some things that are not or what you want to see happen, as opposed to what maybe you think is going to happen, and you're trying to change things. But when you're betting your hard-earned capital, you have to kind of remove your personal wants and desires out of it and just try to analyze it and figure out what's actually going to happen. Because if you're investing your portfolio based on what you want to see happen, it can oftentimes go against you. So the biggest lesson I learned was that at one point, post global financial crisis, as I realized I was being a financial justice warrior. I was investing not only my money, but my clients' money in a way that I thought the world should be, as opposed to how the world actually is. And so if your goal is to actually just increase the size of your portfolio, I think you got to be just brutally honest with yourself, not about what you want to see happen, but what you think is going to see happen. So
Yeah,
that's number one.
the universe and markets don't care what you think or what you want.
That's
Yeah.
right. That's right. And the second thing, and this, Rick Rule told me this years ago, and it took me a long time. And he didn't just tell it to me once; he told it to me several times. And it took me stupid Brent. It took me a long time to figure this out. And he said, if you're going to invest in the natural resource space, you will either be a contrarian or you will be a victim. And what it took me a long, and that's a pretty easy to understand concept. And I thought, because I was invested in natural resources and the typical person isn't, that I was being a contrarian. It took me a long time to realize that it didn't just mean a contrarian versus the rest of the world. It meant a contrarian within the natural resource world itself.
Mm-hmm.
And so that has helped me a tremendous amount, because when you're in, copper or nickel or uranium or gold or silver or whatever it is, when sentiment gets way off the charts, when positioning gets way off the charts, when everybody wants to buy saying, this is it, this is it, this is it, it usually is not it. And that is usually the time you need to be a contrarian and either take some profits or put some kind of protection in place. Now, it doesn't mean that it won't be it. And I'm not saying that you have to do exactly you can't just be a contrarian just to be a contrarian. But my point is that if you are in that space and you are of the belief that the whole world is going to change, and as a result, gold and silver are going to go up X number of percent, that's fine to have a percent of your portfolio allocated to that. But if you have a huge percent allocated to it and those things go up 10, 20, 30%, it's not a bad idea to take a few profits every now and then. You're not a bad person if you take a few profits now and then, especially when everybody else is losing their mind.
All right. Well, very well said. And, I remember Rick, I followed Rick for 15 years or so now, probably more. And I've seen him do this multiple times, but certainly, years ago with uranium, he was out there telling folks about it and just nobody wanted it.
Yeah.
Nobody cared. And it took longer than he would have liked. And I remember his self-deprecating comments, at his conferences, but he kept on that drum. And of course, if you followed him, you made a ton of money over time, right?
Yep.
And so again, you don't want to be contrarian for the sake of being contrarian. And you gave a very good counsel for folks that are, once you have a windfall in this space, if the world has woken up to the opportunity, probably not a bad idea to start saying, right, maybe I'm going to start lightening some of my positions. So anyways, well said. Brent, thanks so much for your time. It's always wonderful, my friend. Look forward to having you back on as your conference gets closer, but thanks for a great discussion.
All right. Thank you.
All right. Well, now's the time on the channel where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined today by founder and co-founder and managing partner Mike Preston. John Loder has the week off. Hey, Mike, how you doing?
Good, Adam. How you doing? Thanks for having me here. Appreciate it.
Hey, thanks. When Brent's on, it's always a fantastic discussion. I've had many conversations with him on the Dollar Milkshake. I've seen him, present it multiple times on stage. I always feel like every time I hear him walk through it, I always find the logic increasingly compelling. It's been a very powerfully explanatory framework for what's happened over the past, many recent years. But I always learn something new every time he walks through it. So I'm so glad that he came on and sort of did a reset there. But anyways, I'm curious, what were some of your key takeaways from the conversation?
Well, Brent is actually absolutely right. I mean, the world needs dollars, and it's not because he loves dollars, and that's not not because he's patriotic. It's because the world needs dollars. There's so many trillions of dollars in U.S. denominated debt. There's so many tens of trillions of dollars of collateral dominated in U.S. dollar debt, and the U.S. dollar has been the world reserve currency for many decades, ever since I think it was perhaps Henry Kissinger that that essentially convinced the Saudi Arabians to hold dollars in exchange for oil and park it in bonds and that type of thing. We're talking back to the 60s and 70s. So it's been our whole lifetimes. And these types of things don't reverse quickly. And so the US dollar is the best option amongst a lot of bad options. In fact, I don't really think there's any real good options for sovereign currencies or fiat currencies. And I tell people that the best currencies are very likely gold and silver and or real assets. That's hard for people to park their money in those things, and it's really hard for governments to park their money in those things. And thus we have the debt-based system that we have. But it's rife with corruption and it's prone to abuse. And certainly I think the United States has taken advantage of that. So, but Brent's theory essentially says that we are going to have a crisis. We believe this too. I think that's where we are in the story, this fourth turning that we're living through, and we're probably more than halfway through it, by the way, ends in some type of crisis. In that crisis, at least in the early days, the world probably flocks to dollars. And so I think Brent's absolutely right there. So the dollar will actually probably get stronger, particularly in the early days. Long term, though, the dollar will probably be in a downtrend. So if we had to guess, we'd say that between now and a couple of years from now, the dollar's likely to be strong and or stronger. But I personally think we're likely to enter a long-term downtrend. I'm not sure Brent believes that exactly, and it's not important, but I think that his point is very important. Don't bet against the dollar, at least short term, or at least don't bet everything, like you said, against the dollar short term. A few other things. I'm just going to throw out the highlights here. There were so many nice tidbits. His timing was wrong. I thought that was nice and admirable that he admitted that he was early in 2018. I've got to tell you, we were early too. We've been in a bubble a long time, at least for 15 or 16 years. It's only gotten a little crazier every step of the way. And right now, I think we're in a blow off top. I think that we might very well get a melt up. I think that we probably disagree a little bit with Brent there. He wasn't willing to say that we can't have a melt up, but he wasn't expecting it.
Right. So it's not his default. Yeah.
Yeah, we think we very well might have a melt up. In fact, it's looking like we will. And yet we're still only about 40 something, maybe 50% if you include gold mining stocks invested. We're very heavy cash and mining stocks. And we tell our clients to have gold and silver because this is a crash prone market. So it's okay to underperform if we get the melt up. And I think it's quite likely that we're going to get the melt up as we speak. The S&P 500 is, we are, what is it, Wednesday, the 5th of June here at 1 o'clock Eastern, and the S&P's 5337.5. So we're about 5 points below the all-time high. We're about ready to take out the high from a couple of weeks ago when NVIDIA reported, and we had that bearish engulfing bar that so many thought was an omen. Well, here we are about ready to take that out. The NASDAQ has already taken it out, and the S&P looks like it will today. So probably getting a melt up here. A number of other things he said was that the transition from the current system to a new system won't be peaceful. He expects a new system. He didn't say what that new system was or likely to be. I think it's going to be a central bank digital currency that'll probably only happen during and after some kind of crisis, and that will likely not be peaceful. He also talked about the volatility being low. The cost of buying insurance is extremely low. And he said, if you buy a put on the S&P 1 to 2% below here, 9 months out, it costs you about 2% of your portfolio. It's probably not a bad bet. However, you could get an even better entry if we're right about a further melt up. You can wait and put it on later. Still, I wouldn't recommend it for people that don't have a very strong stomach, because this market has shown that time and time again, it will reverse on a dime and continue to make new highs. So nobody knows where the ultimate turn will be.
Hey, Mike, let me just interject for a second here, because this is something that your firm, I think, does particularly well, is risk management and look for opportunities to find ways to add downside protection to you and your customers' portfolios, and try to do that as affordably as possible, to get it on the most attractive terms as possible. And we've talked a lot in the past about how, as the markets go up, you continually raise the floors that you have there with the whether you're buying puts or however you're structuring things. So in an environment like this, where the cost of insurance is low on a relative basis, are there steps you guys are taking right now at New Harbor that might be different or more aggressive or more creative or whatever than your standard fare?
Absolutely. We're using options. But let me first say that the very first thing you can do to hedge is to sell down your exposure. We're at about 40%, 50% if you count gold mining stocks. So right there, we are going to underperform just like Brent if we get a further melt up. You're going to have to kind of pick your side here, because even with hedges, there's going to be some kind of cost or deductible if we get a crash. So, and this is a crash prone market. I'm going to share a screen here with a chart of the S&P 500.
Yeah.
Here's the
Hey,
S&P.
and Mike, real quick, just so you can include this in your answer, somebody, especially a novice investor, might say, well, why, Mike? Why not just ride the melt up? If you think it's going to be a melt up, why don't you just, get as many fish in the boat as you can while they're jumping, right? And I think your answer is going to be, well, melt ups are events, and they tend to be very short-lived, and they tend to reverse viciously the elevator shaft down that Brent mentioned. And you get into that sort of nickels in front of the steamroller risk, where you're taking on risk of gain that's not worth the potential risk of loss.
Yeah, I've been in this business a long time, Adam, since 1999, and I've seen two big bubbles burst, and I've seen what human psychology is, and this is all about psychology. In fact, the pushing of the wealth effect by central banks is about using psychology against us, in my opinion. We all have to be in, right, or we feel uncomfortable. And frankly, as Brent pointed out, with this big debt pile that's likely to end in crisis or a debt crisis, you need to have asset prices moving up and to the right to service that debt. So it's all psychological, but I've seen what happens when the market turns. This is the S&P 500. Let me go to a monthly chart. We haven't seen a big drop in a long time, really, in the last couple of years, but you'd have to go back to COVID back here to see a pretty big drop. But I guess in October of 2023, there was a little bit of a pullback. But this market has transitioned, in my opinion, post tech bubble. Actually, this doesn't even go back to the tech. This is the housing bubble. 20 years now doesn't even cover the tech bubble. I'd have to go back a little further, which I will here. Do that quickly and then zoom in. So this one includes the tech bubble. So this was a drop of 60%. The housing bubble was 64% or so. And then ever since then, we kind of went on simulation mode, where the government came in and Fed central banks printed money, and every single little dip has been rescued. I would say that these dips have been rescued too. And I can tell you psychologically, if you look at these arrows here, these tops, people do not sell on the way down. They start to hope for a rebound. Eventually, they stop looking at their statements. And thankfully, the government bailed us out each time, right? And then certainly since 2009, it's been nothing but buy the dip. What makes you think, what makes anyone think that they've got the emotional fortitude to sell on the way down? I'll tell you, nobody does. Almost nobody, in my experience. I would expect this market to lose 2/3 of its value, to get back to equilibrium, just to get back to what you might expect to produce 8 or 10% returns would be somewhere here below the COVID low, right? So that's kind of crazy. Will that happen? Do we count on it happening? Well, we don't count on it happening, but it should happen. That's what history says, particularly at the culmination of a fourth turning and some kind of climactic event that causes us to change systems. So we're riding this the best we can. We're willing to underperform. If I had to guess, I'd say we go to 6,000 on the S&P perhaps, or 5,700 in some kind of blow off, and then fall below all of these levels. And so what are we doing? I'll go back to that answer. We keep riding up this market with puts. Right now, we've got 49.50 puts right here where this purple line is on 15% of the portfolio. So we've got net stock. We got stocks of around 40%. 10% of that is a call option on the equal weighted S&P. That goes away on a little bit of a dip. That's a different chart. So that would bring us to 30%. And then if we get a crash down to here, 49.50, then these puts kick in, which expire out at the end of July, and then drop us to 15%. But there is a deductible between here and here. Now, if we break higher, if we're right, and we go higher, we will take this line and we'll start to move it up. We'll take it and we'll move it maybe to 5,100 or something like that, depending on where we go. So we'll keep moving this floor up, and it costs a little bit of money each time. But eventually the market will tank and that deductible will be paid, and we will immediately start to move to the sidelines automatically.
Okay. All right. Well, as Brent was saying, and I think you guys are pursuing there, the best time to fix your roof is when the sun's shining, and the best time to buy protection is when everything looks great and the protection cost is cheap. All right. So I think you mentioned earlier, Mike, that we've seen bond yields start coming down and seeing bonds begin to show some life again. I believe you said you're making some changes to the portfolio, the model portfolio there at New Harbor. Are you making some changes with your bond allocation?
Yeah, we had a relatively modest position in long-term bonds. Ticker symbol TLT is an ETF or an exchange-traded fund that holds long-term bonds greater than 20 years in duration. Well, we saw a meltdown in bonds starting when the Fed raised rates in early 2022. We entered that market a little bit early in hindsight. We have done some hedging. We actually reduced our position on a bounce a few months ago down to 7.5%. And I'm going to share a yield chart here very briefly. We have been keeping our eye on yields. Hopefully you can see this chart. This is TNX, the 10-year US Treasury yield. And so it hit 5% back here at the end of 2023. A lot of people probably remember that. And of course, if you tuned into CNBC, you'd see all kinds of headlines saying that we're going to go to 6 or 7 or 8%. And this is when mortgages were in the 7s. Well, mortgages are still up there in the 6s and 7s, but yields have pulled off. We went all the way down to 3.8. That's what this means over here at the beginning of the year. And since then, we bounced all the way back to about 4.7. And we did not think that it was likely that we were going to make a new high in yields. We thought this was a partial retracement. And we basically have been keeping our eye on this. And you take a look at this dark blue line, and you got to be careful about technical analysis. I drew this in here, and yes, I know it doesn't encompass all of the points, but you start at the low point and you try to connect as many dots as you can. And so that's my attempt at a trend line. The point is that we pulled back to the trend line in the last couple of days, have broken down through it. We think that 4.3 is a key level. Long term, we think that this 10-year yield is going to go down to 3% or below when we get this economic crisis. So that's going to be good for bonds. So on this break of this trend line on the 10-year bond, we increased our position from 7.5 to 10% for most accounts. So it's not a huge bet, Adam, but I want to point it out that I think this is a good opportunity. If rates go down to the low 3s on the 10-year, then TLT, which is presently at around 93, will probably be 115, 120, maybe 115 would be my best guess. So there's a really good opportunity, and you're getting paid about 4% annually while you're waiting in that trade. So we did make that change.
All righty. And yeah, not for nothing on that chart too. You can notice that if you pull up the chart real quickly,
I'll bring it
again,
back.
Mike,
Yeah.
in the past couple of days, you've had I think you've had the 20-day moving average drop below the 50-day moving average.
That's right. The 20 days of green. Yeah.
Yeah, it just happened there right at the end. And if you look back, the time that happened before was right as rates were beginning to head down pretty aggressively from the 5s, down into the high 3s.
Yeah, there's no guarantee, right? That's why they call this a market. They call it trading. But my opinion is that we will work our way lower, probably challenge the 4% level in the next few months, and then ultimately go lower. Nobody knows when the stock market will turn. I mean, frankly, we don't even know if it will turn. But I think where we are in the story is in the terminal phases here. And I think that these yields will go down below 4 and then ultimately below 3. So there's a really good opportunity in long-term bonds.
Okay.
Other than
Beyond
that, I've
bonds,
already showed. I'm sorry, Adam. Go ahead.
I was just going to say, beyond bonds, are there other changes you're making in the portfolio right now?
Couple things. We just took off our position in Brazil and in Mexico. Unfortunately, there was a big one-day drop in Mexico. The first female president was elected in Mexico. In fact, both candidates were females, and I thought that was great. But the market didn't like the one that was picked, apparently, because the market sold off close to 11% in one day. And we have strict rules in place. We did not sell that same day into what we thought was a panic, but the charts were broken. We breached our stop limit level and we got out. Now, we ended up basically breaking even roughly overall on the trade because we had it for a while. We've been selling calls against it, that type of thing. But we're out of Mexico. And at the same time, Brazil, and these were both 2.5% positions, not big positions. Brazil also technically broke down with the print at 29.50 on EWZ. So those 2.5% positions we sold, and I hate to do it because I believe a lot in South America and Latin America. I know that your guest, Tabby Costa, has been on here often and says that the 4 countries that are investable there are Mexico, Brazil, Colombia, and Chile. And I agree, but we have rules. And if we don't have rules, then you expose yourself to emotion. So we follow our rules. We exited those things. We're looking for other places. We use some of that money to add to the TLT position, for instance. India, by the way, just had an election the day after. India was down 6 or 7% yesterday, but we were pretty well hedged on that within the money call options. And so we're going to leave that position on because we believe in the India story. And more importantly, India didn't break any technical levels. So our rules weren't breached. Lastly, I'd say that gold and silver have been looking great. Silver hit 32.50. I wasn't happy to see it pull back to 30. It pulled back further to 29.50. I think it could have downside even to 28.50. It's really volatile, but it's above 30 right now. I think next up on silver is 34.50 to 35. I think that could happen in a matter of weeks. Gold is sitting at 23.50, consolidating, whipping back and forth week after week. Some people say it looks like a double top. I guess I can show that chart very quickly. Double tops and triple tops don't usually work. And I believe that the trend in the metals is bullish. Here is a daily chart of GLD, a proxy for gold. So we've had one top, two tops. So a lot of bears are looking at this saying, oh, it's a double top. If we have another big move in the next day or two, we'll take that out pretty quickly. If I went to the weekly, or actually the monthly chart would show it better. There was this quote unquote triple top back here that everyone was talking about. And take a look on a monthly chart how gold has done. So it's obvious that it's got some consolidating to do. If I went back to the daily chart, you'll see that it's been all over the place. But once we break this high, I think we go right above 2,500, probably 2,550 on gold. And that's when I think silver goes to 35 or so.
All right. Well, if that does indeed happen, that'll be exciting to watch. All right, Mike. Well, look, I very much appreciate you, sharing your portfolio changes in real time with the audience here, and particularly underscoring the whys of the decisions and, the frankness of which ones are playing out, which ones aren't. I think that's super important because, as I say many, many times, a huge part of the value of working with a professional financial advisor is the discipline they bring to you. It's the distance from our more emotional selves, which for the retail investor tend to much more often than not influence our decision making. And history is just completely crystal clear on the topic that decisions made in the heat of emotion tend to have a much higher probability of being bad ones. And so, being able to work with a firm that has a protocol, a framework that, basically has a lot of if-then statements that you just, you abide by and take the emotional element out of it. Super, super important for helping most people just stay the course over the long run. All right, Mike, well, look, as we begin to wrap up, any other major issues about the week or what you see in the markets right now that you want to talk about?
I don't think so, Adam. I'm just watching the tape here as we talk. Again, we're within 2 or 3 points of an all-time high. I would not be surprised if we have a big up day in the next day or two here to really cause some FOMO in the next weeks and months. So that's not a recommendation, trust me. In fact, I think that one should sell into this slowly. You're never going to get out at the top. So if you have stocks, if you've got too many stocks, which many people do, then start selling into this because you will never have the psychological strength to sell on the way down. Almost always. I know there's exceptions, but I'm just going from experience. Start selling on the way up. If you're watching this program, if you believe that there's too much risk in the market, if you believe what we've been saying about valuations being sky high and never before higher, and that won't last forever, if nothing else, dollar cost average sell into this. Get some real assets if you don't have them already, like gold and silver. Gold mining and silver mining shares look like they're going to catch up to gold and silver at some point. There's good opportunities there, I think, if you don't already have some. And buckle down, because I really do believe, even though we were early, just like Brent was, that the next year or two are going to be very difficult. I think that it's going to become clear that we're reaching the climactic phase of this fourth turning. This can't last forever. This feels surreal. The market is not really much of a market anymore, sitting up near, 36, 38 times Schiller price earnings ratio, close to 200, percent stock, or 180% stock market cap to GDP, et cetera, et cetera. Can't go on forever. So give us a call if you want to chat. We'll do a review of your portfolio. We'll give you from the gut our reaction, our opinion. Even if it's just to tell you you're not crazy, we're crazy too. We're here for you. And so thank you.
All right,
Appreciate
Mike.
it.
Well, look, a couple quick things for folks. One, we polled the audience a few weeks ago, if you remember, Mike, about doing a video with you and your partner, John Loader there, going back over sort of foundational strategies for how investors can hedge their portfolios. We had a lot of strong interest in that. So you, John, and I have picked a date to record. And right now, folks, I've got it on my calendar to release on this channel on Sunday, June 23rd. So that's coming up in just a couple of weeks. So for those of you that have been asking about that, yes, we are going to do it, and it'll be coming out relatively soon. All right, folks, if you enjoyed having Brent on this video and would like to see him come back anytime that his outlook is being shaped by world events, and once he has all the final details of his upcoming conference in the fall, please let Brent know that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And just a reminder, we are getting very close to that 100,000 subscriber milestone. Would love your help in helping us hit that, because yes, we get a fancy, nice plaque from YouTube, but much more importantly, once we hit that milestone, the YouTube algorithms take this channel more seriously and give it more attention in terms of distribution. That's very important. So if you're watching and haven't yet subscribed to this channel, please do take a quick second, because that does really help us here. And then, as Mike mentioned, if you are finding yourself asking yourself, okay, how am I going to navigate this future that we have coming? Maybe Brent, gave you some ideas of things to think about, or maybe you just have a bunch of questions that you'd like to get an expert opinion on. As I say every week, I highly recommend that the vast majority of people watching these videos, unless you've got a really good track record of being a successful do-it-yourself investor already, you should work under the guidance of a good professional financial advisor, but really importantly, one that takes into account all the macro issues that Brent and I and the other guests on this channel and I talk about, employs a lot of the risk management elements that Mike and I have referred to here. When you put all those layers on, the universe of good financial advisors who meet those criteria actually gets pretty small. But if you've got one of them and they're doing a good job for you, great, stick with them. But if you don't, you'd like a second opinion from one who does, maybe even Mike and his team there at New Harbor Financial, then consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. To do that, just go to thoughtfulmoney.com, fill out the short form there. One of the advisors will be in touch with you very shortly. Also, remember, when you're at thoughtfulmoney.com as well, you can sign up for our free newsletter by clicking the newsletter link right there at the top of the site menu. Mike, I want to thank you for hanging with me for yet another week. Interesting times. We seem to be back to sort of the euphoric stage of this cycle. We'll see how crazy the euphoria gets from here. But no matter what happens going forward, appreciate you and John coming on this program every week and helping make sense of it for folks. Really appreciate your companionship here, and everybody else, thanks so much for watching.
Thanks, Adam. It's a privilege to be here. We thank you for that, and we feel very honored to speak to all the people that we get a chance to talk to. And it's very interesting and fun for us. So thanks again.
All right, take care, my friend.